How's everyone doing? It's Monday, 2 p.m. Eastern Time. Hope everyone had a great weekend. I've been slowly installing different toys for my kids. I got them over the holidays. We set up the Nintendo Switch this weekend for my 6-year-old and 4-year-old. So playing Mario Kart, they had a lot of fun. I have a 2-year head start on beating them in video games. So I'm going to enjoy and savor that while I can before they crush me and I can never look back. So it's a cool tradition to pass on. I think video games are good for cognitive function. I think they're good for decision making. Uh, I think the best video games, by the way, for founders are real time strategy games like Warcraft or World of Warcraft, because the number one lesson you learn from World of Warcraft is you've got to build the peons that go make money first. You got to go get the miners. You have to go to the mine and bring back gold. That's the number one thing. You have to get product market fit first. And the funny thing is, most entrepreneurs actually don't do that. They go spend money right away before they go figure out product market fit. So if you're an entrepreneur, my startup founder tip for you is go learn and apply the lessons of World of Warcraft. You know, focus on revenue first, and then reinvest in growth, and then get all the fancy, gadgets and all the rest to advance. So there's a lot happening today in markets. I want to touch on a few topics here. The title is called Blackstone's Outlook and the Case Against Bonds. So last week, talked about podcasts are bad for your health. We said most VCs don't know what they're doing in public markets. Most, not all. And I said private equity is where you want to focus, where you want to listen. So Blackstone published their outlook out actually at the end of last week, as it turns out. And so I thought we could skim that and we can contrast their views against our own house views. That's one. Briefly want to touch on the case against bonds. Blackstone actually makes that case. I only say that because most people find Blackstone credible. So sometimes you got to point to an authority and say, well, see, Blackstone said so. And that gives people the intellectual permission to change their behavior, right? I think it's insanity to own bonds when you have a 3% inflation rate. Blackstone said so now. So, hey, there you go. There are a lot of alternatives to bonds. We can talk about that for those people that need income and liquidity. Other topics I want to talk about are Nvidia. We talked about animal spirits last week, digital assets, MicroStrategy. I want to share a curation from the BG2 pod and talk about some of the mini euphorias we've seen in the markets and some highlights in the Lumida ledger. Let's see how much ground we can cover, and feel free to drop in questions as we go along. So first off, last week we talked about how retail spend data was strong. You see on Visa year-over-year spend from December was 4%, which is much stronger than the year ago period. That's one. Two, we're going to see retail spend data come out later this week. I expect it'll be strong. Three, there are winners and losers in retail, right? So Costco and Walmart are taking share, and Dollar Tree and Dollar General are losing share, and the shift to online e-commerce is still happening. So even though you're seeing weakness in retail as a category, especially today, take a look at Macy's down 7%, for example. In fact, the entire index is down. There, really what's happening is having a separation of winners and losers, and a fewer winners capturing more of the gains, and an increasing number of losers, even as a consumer is strong. So we'll talk a little bit about that. Let's dive in. Take a look at that actually. Let me show you the retail index. So here you go, sharing my screen. It's the XRT ETFs, the retail index. This is at the top line level. Okay, you can see it's had a tough going lately. If you take a look at the winners and losers in this index, let's take a look. The retail index, there we go. These are the one-day winners and losers. More instructive to look at this on a multi-day view. But you see unusual winners. These are names people really don't talk about. that suggests that there's some long short covering here. And then on the loser side, Abercrombie and Fitch, they were down 20% in the morning. Now they're down 2.5%. By the way, this is one of my stocking stuffer buy picks from earlier this year. So I want to make sure to call out winners and losers to be fair and balanced and show you how I handle it. Right. So I actually bought Abercrombie and Fitch this morning, down 20%. I added to that position. And you can do that if you've got 45 positions and you're not overly concentrated on one name. So if it goes down and on news that is actually positive, then you can take advantage of that. So in the case of Abercrombie, they guided higher on their sales and they raised targets. Let me share my screen, share that with you here. Lululemon did the same as well, but Abercrombie is cheaper than Lulu. So ANF increased fourth quarter net sales growth between 7 to 8% from a previous outlook of 5 to 7%. The company expects sales growth of 15%. That's on the revenue side versus prior range of 14%. Lulu also increased. So ANF was down 17%. On that, Lulu is up marginally, about a point. XRT index is down. Macy's guided down 7.6%. And look, if you pick like department stores of your choice, they're all going to be down, which makes sense, right? Those department stores are giving ground to more novel forms. So my theory and what happened is this, is that first off, you started the day with a gap down in the major indices. And we talked about that possibility, on Friday. So what happens is you have traders that will put stop orders to protect against losses. And they'll probably set those stops underneath a key moving average. And so if there's a gap down, then those stops can get triggered. And those stops become automatic market orders. And then they get filled. So I think that's what happened here, because you have positive news and yet the stock sold off. So I bought some. It's down 20%. Now it's down 2.5%. So we're up on that purchase already. And sometimes these technical dislocations happen, and you also see the high volume here as well. Highly unusual when you see those sharp down days on high volume, and you don't see actual weakness in the fundamentals. Then that could be a buy. So that's how I approach that. We'll see how it plays out over the next 6 to 9 months. I won't walk you through my whole story for Abercrombie. About high level, if I were to just outline it a bit, it would be that they're a quality compounder, right? They have a return on equity of 50%. So that ROE matters if you can invest in yourself, if you can actually compound. What that means in the case of ANF is they've got to open up new stores and they've got to have positive same store sales growth on the back book, their existing stores, and on their new stores. If that happens, then those stores are NPV positive. That's what ROE means, right? It's net income divided by your installed base of capital. So that is what a quality compounder is. They can control their own growth by reinvesting in themselves. And you can do it at a high profit margin. They have buybacks of 2%. The price free cash flow is around 12.3 versus the S&P at the kind of 22 times. So I like that. There are not many quality compounders out there actually in the retailer space, right? It's such a crowded category. There were 10 years ago, like Lululemon was a good example of that. 20 years ago, 30. Sears was one of the earlier examples of the rise of department stores. Actually, if you go back like 100 years, grocery chains were growth stocks, like Kroger's. Those were growth stocks. They were quality compounders. They reinvest in themselves. Ritz Crackers was another one. The Ritz Crackers, that was one of the Nifty 50 stocks, by the way, like Nabisco in the 50s. The invention of the Ritz Cracker was considered like a form of innovation. They couldn't figure out how to create such a cracker that maintained itself through preservatives, that maintained the freshness or the seemingly freshness quality of it. I don't like processed foods, and it tasted great. So those are all growth stocks, right? And what do you have? You have today, like then, you have this big transition from growth to value. That's a thing we've been talking about really over the last 9 months or so. In Q4, you had this counter trend rally where growth outpaced value. That's really due to animal spirits, right? People get excited in the fourth quarter. You had the Fed cut 50 bips in September. That added fuel to the fire. Then Trump election happened. That added more fuel to the fire. That got animal spirits going. And retail investors, they love to buy growth stocks. Valuation be damned, right? That's behind us. So that growth to value rotation is happening. So value will start outperforming growth. In fact, if you look at what's working today, the major indices are down. They were actually, I think they've actually been rallying throughout the morning, which is great. But take a look. These roll down in the morning, right? These roll down over 1%. And take a look. 1, 2, 3, 4, 5, 6, 7, 8, 9 of these sectors are up, 3 are down. 10th one, communication, is about to go in the green. So that's called breadth expansion. And the ones that are down, technology, the most expensive category. Communications, which includes Google and Meta, an expensive category. The ones that are rallying, the cheapest, energy, materials are cheap. Healthcare, we talked about last week. Healthcare rallied most of the days last week, up 1.5% today. Financials going to earnings looks very strong to me. I think this is one of those no-brainer, non-consensus opportunities in my book. I think earnings will be very strong with the banks report on Wednesday. You've got deregulation. They've given back the Trump bump. I think they'll do pretty well. So, this is all signs of growth to value rotation. That doesn't mean don't own technology, but within technology, you should position towards value rather than like SaaS stocks, for example, that have an 80 PE ratio. Right. So, or like Google and Nvidia and Meta, those are relatively cheaper than most hyped up technology names. Like, let's say like ARM. Right? What's ARM's valuation? ARM is down 2.4%. It's one of the worst in the category. It's got a forward P of 77. I can own Nvidia instead. It's got much stronger earnings growth at a much cheaper valuation. Right. What about Palantir? Down 5%, broken the trend line. So this was all this Q4 animal spirits pump, and now it's giving back. In fact, what we're seeing this year is an echo of what we saw at the exact same time last year. It's an echo of the exact same themes play out last year, isn't it? Even Q4 of 23, you had the same rallies take place. So it's the same phenomena taking place. And ultimately, it just comes down to psychology. If you really want to break it down, it's just psychology, right? And sentiment. So let's take a look at Nvidia. So the funny thing about Nvidia is, you remember last Monday, it was gapping up 6 points because of the CES show. There's a lot of focus on it. And, gap ups, you generally don't want to chase. We mentioned that last Monday of last week, by the way. So I said, I hate chasing gap ups because, especially Monday mornings, because what happens is over the weekend, you have retail investors hitting buy on a market order. And then Monday morning, there's a clearing auction. There's a market maker who's got to match supply and demand. You've got to get people who are willing to sell their Nvidia stock. How do you do that? You have a clearing price that's several points above last day closing price. And so that's what happened. So today we had the exact opposite of that. And so I bought that. I bought Nvidia this morning. I wrote it on Twitter. So there's Nvidia. This is last Monday. You had this opening gap up, June 6th, a significant gap up. And the next day it gave back and tanked. Okay. And now it's down around 2.5%. So it's been grinding its way higher. And let's see. I made a point to share that I bought Nvidia today at 11:30 a.m., taking advantage of that gap down. So 11:30 a.m. is right around there. Okay. All right. So we're up a little bit on it. Not so bad. But it's the opposite of what you saw last Monday. Now you've got people that are afraid and scared and selling. So I'd rather be a provider of liquidity into that. So here you can see, actually on this chart here, you can see that gap up, significant gap up that took place Monday of last week. Then the hype kept going. And then even the following day, there's a little bit of gap up, and then just the selling starts, and all these people that bought get trapped, and then they want to sell. Then just other dynamics in the market get caught up, right? There's the Biden admin slapped on export controls on Nvidia on the way out, so that didn't help the semiconductor complex on Friday. I don't think any of that matters, by the way. Number one, expect it'll be reversed. Number two, the primary customers of Nvidia are hyperscalers, Microsoft and Meta in the number one, number two position, not China. China's not a material driver of revenue. That's the key thing. So the headline looks bad, but in substance, it doesn't really matter. So that's an opportunity when there's a mismatch between the incoming news flow and the fundamental impact. A good example would be like Allstate. So with these tragic fires in LA, take a look at Allstate. So we bought some Allstate this morning too. So it's the name sold off with these fires. We bought it here, had a good entry on the 200-day moving average. It's up. It's up now. So, but your first instinct last week might have been, oh, okay, like, hey, like sell the insurers. And certainly that's actually a pretty good instinct. You got to research that. And there certainly are names that would be worth selling. But in the case of Allstate, their revenue percentage linked to California, and within California linked to LA, and then their exposure after thinking about reinsurance is very low because they diversify the risk away by selling the risk to reinsurers. And they've withdrawn from all sorts of categories. In fact, the California state set up their own public insurance utility because private insurance stepped away because they said it's not rational to price insurance. So, when you have those instincts, researching them and testing them quickly, and AI can help you with that. We figured out the story on Allstate very quickly with AI. There are other insurance companies that probably have more risk. Here's one. MCY is in the dumps. Take a look at that. Now, this is an insurance company with a concentrated exposure to California. Now, this is beyond our ability to analyze the liabilities from their exposure to California. We don't know. I mean, is it priced in or not? Like, you need a lot more information. But Allstate is such a large company that it's much easier to analyze their exposure to LA versus their entire book of business. This business you don't know. So there are, we also made a sell decision, by the way, in terms of how we handle the LA fire. So we bought Astrana Health on the dip. If you remember, Monday of last week, I said, hey, look, healthcare, I think it's a good opportunity. We bought some. But the morning these fires broke out, we sold our exposure to that business because they're primarily concentrated in Southern California. Now it's up 3% today. Who knows, right? One day, maybe we're right, maybe we're wrong. I don't know. But it's just good risk management, right? Because we don't know. So, those are some areas in terms of how we thought about the portfolio and how do you deal with risk in real time. So one of the things we highlighted last week is how animal spirits were at a 2 standard deviation level. I'm going to share my screen again. I mentioned last Monday that by the end of Monday, animal spirits would be hitting 2 standard deviations. Made a chart, the typo here on Twitter, saying this is all you need to know about what's driven markets for the last 3 months. Best performer animal spirits, worst performer dividend yield. When do we start to see the gap close? My guess is sometime this week. That was Monday. That played out, right? Animal spirits is in the tank. A good proxy for animal spirits are like Twitter, momentum stocks, crypto, unprofitable tech, IPOs, biotech. All of that is animal spirits, right? High beta stocks. And then dividend yield stocks actually did okay. I think they actually rallied, right? So it's interesting, right? You have like this, the mean reversion is making itself felt. Here's a good example. Take a look at like these tanker stocks. They've been doing really well. These tanker stocks, this is TNK. We own this one, and STNG, they're up 4%. This is tanker. But the funny thing about this is that if there was ever a business that was the exact opposite of Nvidia, it would be this, right? It's a oil tanker. They move oil around. It's not digital, it's physical. They're a provider of energy instead of a consumer of energy. It's a business that's been around for decades and decades as compared to Nvidia. It's the exact opposite thematically from tech and AI, and it's done really well. and it's added diversification. So we added this name towards the end of the year when we saw that the whole category is massively oversold, and tax loss selling was going to end. It happens almost every year when you have tax loss selling at the end of the year. Then the selling is done. You can go. There's an opportunity to go buy. So we did, but that was a better opportunity than buying bonds. Like if you bought bonds, take a look at someone owning bonds right now. I mean, take a look at the 10-year right now. It's at 4.8% now. Wow, new highs as we speak. Interesting that markets are rallying despite that, suggesting that maybe that's priced in, right? That's so if you own bonds, right, rates up mean bonds are down. Let's take a look at this. This is TLT. TLT's in the dumps since December 6th. And the classic advice in wealth management is 60-40. Well, that didn't work in 2022. Your stocks were down and your bonds were down. It's happening again. Why do you own bonds? It doesn't make sense. If you have a 3% inflation rate and you're getting 4.5%, 4% in your bonds, right? So those energy stocks that have free cash flow and buybacks and are linked to commodities. Commodities are a natural hedge against inflation. They grow earnings over time. Doesn't that seem like a lot more sensible than buying bonds? So let's jump to what Blackstone has to say. So Blackstone published their outlook for the year. I haven't read any of these sell side outlook pieces, by the way. I haven't read any of them. Not that I don't want to. It's like in a theoretical world where I had unlimited time, I would, but I have to prioritize my attention. This one I will read though, because Blackstone, first off, they're on the buy side, they're not on the sell side. Okay. And yeah, it's just the buy side, they're accountable as fiduciaries to their investor base. Their goal is to make money. They're compensated for making money. The sell side is compensated for pushing product, for getting transactions done, for printing IPOs, for launching SPACs, for broker dealing transactions, for making markets. It's a totally different set of incentives. The sell side will focus on whatever's hot, has attention, because you can get transactions done. Like when Goldman was pumping crypto in December multiple times, that was not a good time to buy crypto, right? So let's take a look at what Blackstone is saying here. So this is Joe Zittel. Joe was the right hand of Byron Wien, who's a guy who passed away. I mentioned him last week. Guy I highly respect. Really an incredible luminary for decades. So this is like a proxy for Byron Wien in my imagination, I guess. So let's see what he has to say. One is productivity growth. The U.S. is a clear leader in productivity growth versus Europe. I fully agree. Productivity growth is a story we've been talking about for a while, right? The U.S. is unmatched in productivity growth. I'm going to share another screen for you around productivity growth. This is a post I made in May of 2024, about 9 months ago. Productivity growth is up. This will help tame inflation and boost earnings. It's a story no one's talking about. We haven't seen this since the 90s. Back in the 90s about the internet. Now it's about distributed intelligence and AI. I don't think the productivity growth we're seeing is from AI yet. I think it's from good old-fashioned management. Immigration played a role in that too. If you can get lower cost labor substitution, then that'll be a driver, a partial driver of productivity growth. Lower cost of goods sold, that'll play a role into that. What's up, man? So things are good. Thanks for joining. Yeah, we got a podcast coming up soon. This will be fun. Tune in with JT. It's always fun to catch up with JT. So let's get back to it. Yeah, productivity growth is a real story. It's an exciting story. Productivity growth is the only free lunch because you can grow earnings, which helps stock prices. You can pay more for labor, which helps labor, means less risk of strikes, less risk of capital versus labor. And there's been a lot of those disputes, right? Look at the United Auto Workers Union Screenwriters Guild, union strikes. There's been a lot of that tension. So productivity growth is the only free lunch. And yeah, we're, the U.S. is preeminent in outrunning other economies, right? Like American venture capital, American public markets, American management, uh, American angel systems, Y Combinator, how to startup guides, all of it, the culture of entrepreneurship. You go to a bookstore and you read, you have magazines dedicated to entrepreneurship. You have books about Steve Jobs and all the rest, right? So that's not going to stop anytime soon. China stimulus reverberates. So perhaps the greatest change in the global economy from 2016 to today is a downshift in China's economic momentum. So 2016, of course, is when Trump 1.0 was in office. Blackstone goes on to say, policymakers are well aware of the challenges they face. Beijing unveiled stimulus initiatives amounting to approximately 10% of GDP, which is a significant commitment, yet one that may prove to be just the opening salvo. For perspective, China's stimulus during the great financial crisis was 25% of GDP. So a couple insights there. One is they can add fuel to the fire if they want to. China did not engage in these $1 trillion stimulus programs like the West did during COVID. So they have ammunition. They can do that. The West went too far. China didn't do anything. So China's got to add a little gas to the fire here. Today's challenges may demand an even more forceful response. The depth of China's property market difficulties is a particular concern. Okay. So we bought PDD, actually. We bought PDD Friday of last week. So yeah, we're back. We're back. So hopefully you didn't buy China when David Tepper said to buy China. I wouldn't hope he didn't do that. We've had a fun relationship with China. So you heard me say it here first. Uh, we bought China during this capitulation moment. You can find this all on Twitter. Then they cut rates. Then China went up, and then David Tepper goes on CNBC. Then you got that hype right here, and then it just leaks and leaks and leaks and leaks. So we bought it last Friday. So wish me luck. Thoughts and prayers. I feel like I 1 to 2% weight, by the way. We have two names. I bought QFin also. We'll see. We'll see how this goes, right? If this were to break down here, I would get out, incidentally. But it's got a good technical level. I also like Tencent in China. I think if you're going to own a dislocated market such as China, you should own the very best. It's like buying JP Morgan during the banking crisis. Same idea, right? So we'll see. We'll see how Tencent does. Looks terrible on the chart, to be candid, but it's also the best in the business. We'll see how we didn't add to that position. We bought the other two, but we happen to own Tencent also, legacy position, right? So anyway, okay, we got a hardcore question here from Shikar. So hey Shikar, hope you're doing well. Happy New Year. Can sustained productivity growth mitigate the economic impacts of an aging population and declining labor force participation rates? There's a lot going on there. Well, sustained productivity growth, if the quantity of productivity growth is greater than the reduction of the labor force, then yes, right? So really, those are the two curves to take a look at. Obviously, robotics and automation are a big part of this. The question is, and I had a great interview with Michael Perek. We talked this past Thursday about Nvidia, but we have a prior podcast in May of this past year where we talk about robotics. And his conclusion was that robotics as an opportunity to help with assisted living for the elderly and help with nursing for the young is too far away. Like the initial use cases would be around industrials, packaging, moving boxes. Think about what Amazon is doing with robotics. Those initial use cases. They're not handling flesh and people. They're handling boxes and cargo, or like forklifts, I guess, right? So those are the initial use cases. But how long do we get to assisted living use cases with a graying population? That's the big question. My own guess is within 5 to 10 years. I mean, I think the pace of AI is strong, right? You saw DeepSeek; they released a model as competitive as OpenAI. There's reports saying they built it for $6 million. I mean, the truth might be closer to $50 million, but it doesn't really matter. It's still a fraction of what OpenAI spent, right? And you have these multimodal vision models. Google Gemini 2.0, their Flash model is multimodal, and as strong as OpenAI, and a bigger context window, and it's free, right? So I think there's a lot that's going to happen around robotics. How do you play it? I mean, you own Nvidia. That's how you play it, right? So I mean, I'm sure robot stocks as a theme will do well for a bit, but those themes are not doing well today because those companies aren't making money today. That's why, right? It's like, if you want to make money in investing, invest in things that make money, right? If it's a trade, that's different. Trades are different. Remember, we talked about quantum stocks last week, and what I said was more hype than substance. Let's take a look at quantum stocks, right? Quantum stocks not having a good day. I think the hot ball of liquidity has moved on from quantum stocks. That's QTUM, right? So yeah, that's just not good, not good. Here's Rigetti, down 30% today, right? So, by the way, what were those Bill Ackman preferreds? Let's take a look at those. The Fannie Mae. I haven't looked at this only because everyone's talking about it, so therefore I have no interest in it. But you can see the declining momentum around this, right? The rate of change starting to slow down, like you saw here. So I don't know. That's a trade. It's not an investment, right? All right, let's get back to it. So Blackstone, follow private equity, follow the smart money. Blackstone is in that category. So balancing act, global stimulus gains amid trade uncertainty. So they say, in our experience, analyzing markets through multiple cycles, the combination of synchronized global rate cuts and substantial fiscal stimulus has proven consistently effective at reinvigorating economic growth. That's bullish for international markets, bullish for international value, bullish for breadth expansion. The transmission mechanisms are well established. Lower borrowing costs facilitate investment, while fiscal spending provides direct economic support, creating a multiplier effect that ripples through the global economy. So Blackstone, they've got Keynesian economists there, right? So anyway, let's keep going. Liquidity conditions could further improve if European policy rates decline as much as the market expects. However, the optimistic outlook must be tempered by acknowledging potential headwinds, particularly the specter of renewed trade tensions. The return of America First trade policies introduces uncertainty into global supply chains and trade relationships that have only recently stabilized. True. No one really knows where these tariffs are going to net out. I'm trying to crack the code on this, and the story on tariffs continue to evolve. So I'm going to pull up a post here that shows some of this evolution. So where we were a few weeks ago was this term of reciprocity. They shifted from tariffs as a source of revenue as a way to displace income tax. Remember that? They said, hey, tariffs, we don't need income tax. Oh, I would love that. I don't think that's realistic, though. I don't think it really makes sense either. But they moved from revenue to reciprocity. I like reciprocity a lot because it's very hard for GM to sell, or Chrysler or Tesla, right, to sell into France and compete against Renault, or to sell into Italy and compete against Fiat, or sell into Germany and compete against BMW, Mercedes. Like, reciprocal makes sense. Like, pry open those international markets, bring the best out, bring competition out, right? I thought that made a lot of sense. So this I thought was a good shift, but we have another shift. So I think the issue is that it's very hard to come up with a coherent, rational tariff policy. It's difficult because if you squeeze in one area, then there's a consequence felt elsewhere. Here's an example. So this was based on a Washington Post article on tariffs that came out last week. Trump denied it. The street view is that it is a credible report, though. So it goes on to say that policy continues to evolve. We were at bilateral and reciprocal. That's what I just showed you a few weeks ago. Now we're at universal and targeted. So, well, how does that work? So if you have tariffs on steel, that protects American steel, but it increases defense costs. Take a look at Lockheed Martin, Raytheon, General Dynamics. These are all in bear markets. And Trump wants Europe to pay their fair share for NATO, which makes a lot of sense. Canada contributes like 1% of their GDP to NATO. They are getting subsidized. Europe, on average, is getting subsidized on NATO. It's true. But how are they going to buy Raytheon if you've got tariffs on these names? Okay, Raytheon is up today in a downtrend. Oh, the defense stocks are cranking today. Interesting, huh? Let's see if that's sustained or renewed, but that is interesting. It helps to look at these charts, right? But notwithstanding this recent, again, 1-day move, we'll see. But you can see 265 divided by 315. 216 divided by 315. We'll do the math. 265. Yeah, it's about a 16% bear market. Before today, it was around 18%. So 16%, 8% correction, right? So how do those industries compete and win if you have tariffs, right? So foreign dependence, eliminate foreign dependence. I think that makes a lot of sense. But how does that work if you've got a dependency on rare earth materials from China? Why not exhaust the supplies from China before slapping tariffs on rare earth materials from China that we need? It's hard to do that. How do you, if you squeeze here, you pay a cost there. So I think that's the tension that they're facing. Another one is like these manufacturing jobs, right? Well, I don't know anyone that wants a manufacturing job. I really don't. I mean, I don't know anyone that wants to have their sons or daughters work at a car factory. These are hazardous jobs, dealing with like heavy electrical equipment, get a gear on you. Like that's where workman's compensation comes into play. Like those jobs should be automated away with robotics. It's not the future. Manufacturing is really not the future. The future manufacturing is robotic manufacturing, what Tesla's doing, actually, right? So, and then you got the service economy. So I think that's the issue. I think they're struggling to craft a coherent tariff, but there's a way to do it, I believe, actually. I think back where they were not too long ago with the whole idea of reciprocal and bilateral tariffs, I thought that made a lot of sense. Pry open markets and to have a competitive, open, level playing field. But they're not there yet. So let's get back to Blackstone. Okay, strategic investment implications. That's clearly a GPT-4 phrase. Whichever analyst put this together is clearly using GPT-4, right? This is GPT-4 talk. Okay, nowhere is the need for new thinking more apparent than in fixed income allocations. For 40 years, investors benefited from a fixed income bull market as yields fell from elevated levels in the early 80s to the bottom during the pandemic in the 2020. Remember, we saw the 10-year go to 1.5%. Now it's 4.8%. A period nicknamed the Great Moderation for its dormant inflation. Okay. Government bonds have lost attractiveness as a method for hedging equity drawdown risk. It's a key takeaway. Why own bonds? In only a few quarters over the last 2.5 years have government bonds returned in the opposite direction to equity returns. There's no longer diversification benefit for bonds. All right. So I love this chart. It's a great chart. So 1982 was when you had the greatest bull market kickoff at the end of a recession that was caused by Paul Volcker raising interest rates. One of the few things Jimmy Carter got right, by the way, appointing Paul Volcker to be the Fed chair. So, he raised interest rates, caused a recession, and that they won the battle on inflation. And you had an incredible bull market start. It took a lot of leadership to get there, right? The easy decision would be to just tolerate inflation and you wouldn't have had the outcome we had over the last few decades. But that was a good move for Jimmy Carter, right? So, uh, but here you see it's been going the other direction. This has hurt commercial real estate. It's mortgage rates are now 8%. There's no longer quantitative easing, so the spread between mortgage rates and comparable duration treasuries are all-time highs. Right, mortgage rates are 8% now. Home builder stocks are in the dumps. So that's reversed. I think this is a good point. So why would you want to own bonds? An allocation to private credit helps mitigate some of these challenges. Now, this is where they're pushing their own product. Blackstone has their own private credit fund. I don't like it at all, by the way. If you remember, they had BREIT, which is a collection of real estate portfolios. They had to put a gate on that. And there's all sorts of shenanigans that can happen there around who marks the value of those assets, right? Blackstone gets to mark those assets. So they have a private credit fund called BCRED. I'm not a fan of it, but I think the thesis they have is right. The issue with Blackstone is that they're so big, they have to be an aggregator. They've got to originate so much product that they actually will source loans from other private equity firms that are smaller and have more scale and are nichier. And they'll aggregate that. They'll negotiate a special fee, package it up, and then sell it. So what I do, I invest in private credit also, but I go direct to the end market and find those private credit players, some of whom actually Blackstone buys from, and try to find the best players there. So I think that's a great idea. I mean, private credit, you can get a 12 to 18% coupon. Now that might be somewhat lower because the Fed fund rate has come down. And if it's a shorter duration loan, let's say, right? But versus a treasury, I think it's a great idea. If you don't need the liquidity, why wouldn't you replace bonds with private credit? It's good to have income that's not tied to the volatility in the markets because you can take advantage of situations. You can sleep better at night, improves your psychology. Psychology is everything. If you have the psychology to weather the storm, then you can take advantage of opportunities. You sleep well at night because over time, earnings growth goes up and stock prices go up and bear markets are rare, right? The 22 bear market lasted 9 months. Even the 2008 market was a year and a half. So, private credit can generate the income so that you can achieve your lifestyle objectives and therefore stay the course and invest like Warren Buffett did in October 2008 and buy assets when they're cheap. So, but bonds, I don't think bonds make much sense. And I agree with Blackstone. This is something we've been talking about for a while, right? Let's see. They talk about the case for allocating to private equity is particularly strong. They're pushing their own product here, right? This is now they do make a good point. The S&P is expensive based on historical valuations. That is very true. But the thing with Blackstone and private equity is that they're competing with Apollo and KKR and all these other private equity firms. So the investment banks will find opportunities. They'll go to Blackstone. They'll knock on everyone's door, and they have a competitive auction. There's a dynamic called the winner's curse. So in an auction, whoever pays the highest price wins. And that's what sets up the winner's curse because you paid the highest price. So you're eating into your own IRR. What you want are uncompetitive auctions. You have markets that have no bidder. And those are usually secondary markets like commercial real estate. We were investing in markets where Blackstone's not playing. They're not in that game. Find a private equity guy that's sourcing deals from a community bank that needs liquidity because they're getting pressure from the regulator. That's a better opportunity. Then they're a price setter. They're not a price taker. So I think Blackstone has the right thesis, but the implementation, which is invest in Blackstone private equity, I think the implementation is wrong. Investors could move to small and mid-cap stocks where valuations are lower. However, swapping some of the large cap exposure into private equity could be more impactful. Whether looking at public or private markets, high quality companies with strong cash flow generation, robust balance sheets should command investors' attention in this environment. I agree with that. Here's another name we bought this morning. Bumble. Bumble is on sale again. So that's good. I like Bumble. 5.3 forward PE ratio. That means in 5 years, I get all my money back, is one way to think about it. And they've got a buyback yield. Here it says 40%. I think the sustainable buyback yield is actually closer to 25%. So, and yeah, they don't have any upcoming debt obligations. So I think I can just sit and wait. It's free cash flow and buybacks. Those are two of my favorite things. All right. So we covered some ground there. Let's jump to this excerpt. Nvidia versus Google, Mag 7 AI. Are we in a bubble? Is the bubble over? So Lumida, we do these curations. We go through these podcasts because there's a lot of alpha trapped in podcasts, all the nonsense in podcasts, mostly nonsense, but sometimes alpha. Right. So we go through these. It's on the Lumida Wealth handle, by the way. You can follow it there. It's also in the Telegram group. We have a Telegram channel. We break it up by category, like China and AI and crypto and Mag 7, etc. We try to find the best clips. So let's take a look at this clip.
Microsoft, Meta, Nvidia, Amazon, and Google grew earnings at 44% in 2024. Stocks were up a lot, but Bill, earnings were up tremendously. 44% is extraordinary. If you look at the S&P 500 as a whole, because of the tailwind of the Mag 5, the S&P 500 as a whole was up 9%. If you look at the other 495 companies in the S&P, their earnings only grew 2%, right? So it was pretty anemic earnings growth in the S&P 500 in 2024 relative to the Mag 5. If you look at it now, what's expected, what the consensus forecast is for 2025, we see the Mag 5's earnings growth comes from 44% down to 21%.
How much of that has already started, Brad? Do you know what Q4 was? That deceleration.
There's certainly a deceleration in these businesses. Remember, they're coming off of easy comps, and by the time you get to 2025, it's very hard comps. And still growing 20% on the massive earnings and revenue bases of these companies, pretty extraordinary.
So yeah, key headlines. Mag 7 is generating earnings, or generating the bulk of earnings in S&P. Doesn't mean that other companies are not. We owned App, for example, still own it. There are plenty of other companies generating earnings too. But let's take a look at this other clip too. Actually, before we go there, I'm going to share this. If you break out where in Mag 7 the earnings growth is coming from, I think that's the question, is how do you position? Because valuations are high. So take a look at this. This is the Mag 7 forward PE. And this line here is called Tesla. So Tesla is once again at elevated valuations. I feel like I should get that Bernie Sanders meme. You know that Bernie Sanders meme, like where he has like this public service announcement sign? I just say like, once again, Tesla is at a forward PE of 135. So this is where the valuation run up has happened. Actually, if you take a look at Amazon, there's been valuation compression, multiple compression, the blue line. Amazon's actually pricing these other names, right? It's pricier. Take a look at Microsoft. Microsoft is spending a boatload of money on Nvidia. That's why it's lagged. Remember, if you're spending money, that's an expense. It's lagged. Microsoft has lagged the S&P. And Nvidia is at a balmy 30 forward PE. More relative value than Amazon, certainly Tesla. Meta's in the low 20s, not bad as well. Also spending a bunch of money on Nvidia, but they've got the revenue and earnings growth, right? So, without Mag 7, you can see that the S&P market cap would be considerably lower. And these are incredible businesses that are compounders with monopolies and significant competitive advantages, right? So, so you can see the run up in Q4. It's positive seasonality. This is all animal spirits, right? Tesla was up 57%. Nvidia was down. So I think this is actually going to reverse. This is the Q4 story. Similar thing played out Q4 of last year, by the way. Nvidia really got going just after the new year last year. Okay. So the key thing here would be looking at the fundamentals. So anyway, quick detour into Mag 7 there. But also like consider like Apple. Remember, I don't know if you guys remember this. This was a Christmas Eve. I had the tail end of walking through our stocking stuffers. We talked about Apple. Let me share this one with you here too. This is a funny one. Let me show you Apple is now once again more expensive than Nvidia on a 4 PE basis. So I will be more vocal about Apple once again. Look at this is Apple. Apple is almost as expensive as it's ever been before. You're not supposed to own Apple here, people. Is there a bell? Can I find a bell? They don't ring a bell at the top, right? I need to get a bell. Here we go. Okay. That didn't make much of a sound. I tried to create some dramatic effect here, but you get the point. Apple's earnings growth. Let's take a look at Apple's earnings growth. This is going to lag. This is going to lag. These names all rallied at Q4 seasonalities, retail, stock buying, same thing with Tesla too. Okay, they're growing earnings 20% pricing for next year. That's a massive increase from where they've been. That seems to me price for perfection. Did you buy an iPhone this year? Did you get the Siri upgrade? I wish I had that double shot espresso because I clearly had a lot more energy on that day. So, Apple was at 258 on that, and now here's the lag, folks. Here is the lag. It is now at 233. That probably stabilizes here. Who knows? But yeah, this is what they don't ring a bell at the top. I wrote that in right there. That was literally the top. That was pretty good, huh? But yeah, the point is these names will lag once again. Apple and Tesla will lag once again. And it's a repeat, it's an echo of the theme we saw last year, right? So in Q4, people buy iPhones for the holidays and they think they're the next Peter Lynch. They say, well, Peter Lynch said, buy what you know. I'm going to buy Apple. I don't care about the valuation. So they bought Apple. And, Apple's going to lag. They put their bonus into Apple and Microsoft, right? And Tesla. So it was a great trade. It's a great trade, right? The question is, did you rotate? Did you rotate, right? If you take a look at what's working in the markets today, what do we see? Let's take a look. It's all rotation, isn't it? It's a worst to first: energy, materials, healthcare, industrials, real estate, financials, consumer staples, even, right? Utilities did like 30% plus last week, down, tech down, communications down. Now, I would own these categories, just to be clear. I'm just saying that, positioning across these categories and within these categories matter, right? I'm not sure I'm excited about consumer staples, right? People don't want sugary products anymore. Look at like General Mills. Do people eat cereal anymore? Right? I'm not giving my kids cereal. Take a look at General Mills. It's a consumer staple stock. I don't want to own that. Do you want to own Nike when their marginal consumers in China and the Ford PE is higher than Nvidia? No, that's why Nike's down. It doesn't matter they've got a great brand. It's not worth it. What about Starbucks? Do you really want to own Starbucks in consumer discretionary when people are making coffee at home with Nespresso machines? It won't load up here. So the positioning within those categories matter, right? So Mag 7 will be fine, but not all Mag 7. That's my thesis anyway, right? Let's see. So topic I want to wrap up with is we have seen these mini euphorias. Let me pull up a few of these charts now. Okay. So bull markets end in euphoria, right? This is Axon. I think we have a short in Axon, by the way. And we have like a couple dozen small shorts. And we cover them when we see a good opportunity. Anyway, so this stock has got a 98 Ford PE ratio. It's not growing as quick as Nvidia. It had a big retail pump last year. I think the show is over there, right? How about FICO? These are all great businesses, by the way. In fact, I owned Axon and I owned FICO last year, by the way. Funny, right? So FICO, fantastic business. Ford PE 65, it's leaking. What's happening here, my read, is that you've got institutions that have a VWAP sell order. That's what creates this kind of pattern as compared to, say, an ANF. An ANF down 7% a day. Those are stop orders getting triggered, probably by retail investors, right? So it's a different kind of sale. that's happening, right? How about Kava? Remember Kava? This thing had like a 300 PE ratio. Like if you took every salad you bought from Kava and instead bought the share price, you probably would be retired, right? But look at this. This thing is it's at 111, peak at 168. So what is that? That's down 34%. And even if you just take it to like this level here, right? 111 divided by 149, that's 26%. So, that's expensive. Would you rather own this or would you rather own Nvidia? I'd rather own, well, not just Nvidia, but plenty of other things. That's the point, right? So I'm just showing the contrast there. But, this will, land at some point here. And that's good for these kinds of names, right? Because many of them are tracing out kind of similar patterns, right? How about, remember Chipotle? Let's take a look at Chipotle. Yeah, Chipotle does not look good. Bill Ackman is selling. He's reducing his exposure. So, this stock has a 4P of 45. Meanwhile, Nvidia has a 4P of 35. And no one's talking about it right now. We're talking about it less. I mean, people are talking about it. People are talking about Nvidia in the context of these export controls. But the thing people are missing is that China is not a big driver of Nvidia's revenue or earnings or their expectations. The number two customers are Microsoft and Meta, not China. China isn't even part of the equation, not even part of the forecast. So it's markets overreading a headline. That's news flow that retail investors read. They thought they had alpha because they read a Wall Street Journal article. And they hit sell. So I'm buying from them this morning, right? And what's going to happen is Trump will let Saudi Arabia buy GPUs. They cannot right now. They want to build 60 data centers. That's the opportunity, right? For instance, but do you prefer pair trades, e.g. long Nvidia, Meta, short Apple, or rather than as long the quality names within the themes? I think shorting is very hard and most of you will screw it up, so don't try. Okay. Like there's a cost of tuition in that. So don't even spend your time trying to figure that one out. Okay. It's it's a different way of thinking entirely. It's a very different way of thinking, and names that should go down won't necessarily go down also, right? So, there's a lot you have to do to line it up. And you got to do a diversified basket. Otherwise, because if one runs, then that can hurt you, right? So, but I do think it's the right way to invest because you can fund more longs, right? Like I'd like to own more of the names I own, but I can't because the weights have to sum up to 100% mathematically. So I have positions that have like a 1.5% weight. I want to own more of it. I can't. I can if I'm shorting names that I know or I believe reasonably will lag and use that as a source of funding to own more longs. And even better, if I'm correct on the direction. If they just merely lag, I'm adding value. If they just lag, I'm adding value. Right? So it's like when you get a mortgage on a house, the cost of the mortgage is 2.5%, and the price appreciation of the house is 6%. You're capturing that spread. It adds value. So even if the short leg grows in value, but it lags, you're adding value. But if you make money because they decline, then you have double alpha, right? And I think there are opportunities like that. More that'll increase with AI because you have more winners and losers, more separation, right? Look at semiconductors, the leader is Nvidia, right? Look at SMH index, for instance, right? The equal weight indices for many industries are actually lagging. So that's just capitalism, right? The winners take the lion's share of the spoils. What did Buffett say? Make sure you're number one or number two in your category. No worse than number three, right? So if you own leading businesses in those categories at good price, good earnings, you'll do well. What's working? Healthcare. We talked about healthcare last week. Healthcare is still working. These are fantastic businesses that are cheap. Like you're not supposed to buy healthcare this cheap. I didn't own healthcare for like 2 years, and then they started getting cheap in Q4. But we think the worst is behind it. But the other name, I would focus this week on financials actually, because you have earnings season coming up on Wednesday. So financials are up today. And I think they'll do well. The consumer is strong. You have household balance sheets are strong. They're so strong, consumers are paying down their credit card debt. And people look at that and they get scared. Like, oh, is that bad news? No, it's not bad news to have consumers pay down their credit card debt. So I think this category will do well, on Wednesday. So let's stay tuned and see what happens. So big call, calling for rotation to value longer term has crushed many investors in the last 20 years. No. The answer is no. The answer is no. I shared this study. Let me see if I can find it for you all again. It's really a misunderstanding of value, right? So I'm going to pull up, we did a back test, and you can look at like certain indices to get a sense of this. It doesn't mean like buy a value index. Let's see. But we did a study looking at what happened if you bought stocks that were cheaper versus stocks that were more expensive over 10 years and 5 years and 3 years and 1 year. Okay, I'm going to share my screen and share that finding with you. Okay, give me a moment here. It's from a show we did 3 weeks ago, by the way. If you can dig it up there. If you want to take a look, we actually walk through these factors. So I would refer you to that one. Really the mistake with a lot of these like strategists, by the way, they'll say like, oh, you should buy mid caps, you should buy small caps, you should buy large caps. What you should do is buy a good asset with a good valuation and a good earnings growth, ideally a good trend in whichever of those categories, and you'll do fine, right? So, another name we bought this morning is Jackson Financial. So this name is right at its 200-day moving average. It's got a forward PE of 4.2. It has, once again, a good technical entry. And they've got buybacks of 6.5% and a lot of free cash flow. But, this name has done about 7% a year, right? It had a nice pullback. This thing went parabolic right around here, by the way, right? You can see that. Oh, shoot, am I sharing my screen? Let's see. So, but compare that to the IWM index, which is loaded with mostly garbage stocks, right? IWM index hasn't really gone anywhere. So the point is, find a good asset. This has gone up 12%, but plenty of names within there have done very well. Build-A-Bear, remember Build-A-Bear? That was on our stocking stuffer list for 2023. So that was up 80%. So it's focused on finding the right asset, finding a good asset, right? Regardless whether it's like Mag 7, mid cap, small cap, China, et cetera. You should consider those other forces at work, of course, but it just underwrite to a good asset. That's number one. What else? I think we can call it a wrap there. Let me see if there's anything else that is worth sharing. Yeah, look, I think we'll call it a wrap. Look, bank earnings coming up Wednesday. Stay tuned for that. I think they'll be good. How I feel about markets overall, we bought the dip this Monday. I think animal spirits are still rolling over. I don't think that it's done. We had that +2 standard deviation move last Monday. So it's going to take time to work that off. So that category, I'm not excited about, but I think other categories will do well. And I think banks are one good example of that. Insurance companies are a good example. I think mortgage rates are on the higher side now. They're going to come down. It's hard for me to see them going higher. If that's true, then home builders will do well, right? Like those kinds of categories, I think will do well. The fly in the ointment I have is that we didn't really get a perfect flush this morning. We didn't get a perfect flush. So like if you have that, like remember August 7th, Monday morning, markets were down 2%. You had a lot of fear in the markets. The VIX spiked significantly. You had capitulation. The fear was palpable. is palpable. We don't quite have that here. We do have elevated fear. The VIX is at 20. You do get bounces from that level, but the fear isn't palpable. That's the one. So what that means is you'll get some kind of bounce, but I don't think it'll be as strong as what we saw coming out of August 7th when there's real fear, right? Because what happens is when people get scared out of the market, strong hands buy those names and all the information is priced in because by definition, they know the information when they're buying it. That's what pricing in means, right? That's a pricing event. Now, I think you'll get some kind of bounce, but it might be weaker, right? And probably we see more of this for this year. I think this is a year where nimbleness will do well, and stock picking will do well because you're going to have more of these winners and losers play out. So it's going to be a more difficult year than the last 2 years because the last 2 years are all about beta. It's like stay invested, you'll do fine. I think this year will be an up year too, but I think positioning will matter a lot more, right? So, all right, hope that was helpful, and we'll see you next week. Be well now. Make it a great one.